Hey everybody, this is Dr. Tom Carr, aka Dr. Stoxx. Welcome to this members-only edition of Market Talks with Dr. Stoxx. I'll likely be posting this to our blog later in the week, but I want to get this out to our subscribers this weekend because we have some interesting things to talk about. Hey, I want to first point out that we're going to be launching a new service in early November that focuses on options trading. I want to show you what I've been doing here. And this is something I'm going to be teaching more thoroughly in an upcoming webinar, which I hope to have out to you late October, just before the launch of the new newsletter early November. And in that, actually, we're going to come out with a series of webinars. We're going to be talking about using monthly options for income plays. We're going to talk about weekly options for income. And then we're going to really get some exciting stuff going by talking about how to trade very short term, even day trade, near-term weekly options on very specific stocks. And you're going to see some really fun returns here in just a moment. So I've been doing this in a dedicated account that I put $25,000 into starting in late May, the 22nd of May. You'll see that time stamp here. I've been keeping track of each of our trades. And I took 80% of that $25,000 or $20,000 and I've been putting it into a series of option plays, mostly credit spreads on the major indexes, naked puts on select well-known stocks, and then some, in most recent weeks, calls and puts on using those short-term weekly options. And the returns have just been, oh gosh, a lot of fun. Because with the credit spreads, if you do them right, as I'll teach you how, your win-loss ratio is way up above 90%. We're hitting about 95% right now, which is nice. Now, you're not winning a whole lot of money on each of these positions, but they're very safe. They let you sleep at night. And hey, with a single contract, I mean, you can see with a $20,000 size account, I'm putting on only one or two contracts, maybe three here and there on these credit spreads and these naked puts. And I'm pulling in, here's my profit loss, $320, $350, $400, $410, $270, $80, $100. And here are the days in the trade. So some of these are monthly option plays, 30 days, 18 days, 25 days. Some of these are in much less time than that. So some credit spreads here were sold after 4 or 5 days. Those are likely weekly credit spreads. Some naked puts we're only in for a week or two. But you can see that we're pulling in some really consistent gains. And the losses are sizable. So here's a credit spread that lost $1,350 on 3 contracts. But as I said, that's a kind of unusual thing. So we started this back in late May of 2014, and here we are, what, about 3.5 months later? And if we scroll down, our current account size on this is $24,400. So we're up 22% on this side. 80% of our money is in this set of systems. You'll see here, by the way, a lot of puts and calls, puts and calls, puts and calls. These are the very exciting near expiration weekly option trades that I've been putting on stocks that you'll recognize. A lot of ETFs, Priceline, Apple, Baidu, things like that. And yes, there are some losses, and you can even lose 100%, as I did one time here. It's just 75% loss, 40% loss, 30% loss. But look at these gains: 484%, 126%, 50%, 63%, 218%, 74%. So the wins, in terms of percentage, on a percentage basis, will outpace the losses. I'm going to teach you how to do that in a webinar come late October, early November. I've got the other $5,000 of this $25,000 account, by the way, in my momentum letter trades. And I've been taking both longs and shorts, putting $5,000 into the longs and then using margin to short $5,000 worth of the stocks that show up on our weekly scans. And here's the total return over here on the right-hand side. You can see it took a little bit of a loss at the beginning. May, June, early July, and then it started to pick up pace. We hit a high of 35% return, and we stand right now at about 22%, so just about the same amount of return as we have on the options side. If we put those two accounts together, our current account is trading now at $30,512 from a $25,000 account. That's a 22% return. in about 3.5 months. I'm going to show you exactly how to set up this very same system that I'm using here, and we're going to teach you all about that. And we'll come out with a weekly newsletter that you can subscribe to get some of these option trades that we've been talking about. All right, I just want to throw that out there. Let's look at the markets. So we're in a bull market, of course, and this is a chart of the S&P 500. And if we draw our characteristic 45-degree angle line, we can see that this is a very sustainable trend, and we've got some nice short-term dips below that mid line, and most of the price action is staying above that line. So all of that is healthy for a bullish run. That's the kind of thing you want to see in a healthy bull run. However, as you'll see, recent price action fell quite a bit below that midterm line, and it's having a difficult time getting above that line. If we erase that midterm trend line and we draw in the channel lines, we can see there's our uptrend line more or less, something like so, and here's our line under the three or four major support pivot lows, and we can see that the trend is getting narrower and narrower, which is not something you really want to see in a bullish market. This is the RSI indicator. We're seeing a little bit of bearish divergence work in here, not a whole lot. Nothing to be too terribly concerned about, but it does seem like we may be getting ready for a pullback, which I define as a drop in price down to the 50 period moving average, or something more like a correction, which is where price drops below the 50, even below the 100 period moving average, and much closer to the 200 period moving average. We've only really had two corrections in this uptrend so far, and those are the two corrections. Then we had two pullbacks here, and I'm looking for at least a pullback, if not a correction, coming up in the next 4 to 6 weeks of trading. So you want to be a little cautious going forward on the long side of things. You might want to throw on a few puts if you have long positions that you're concerned about, or you might even want to hedge the market with some VXX calls or puts on the major indexes. And again, the options strategies that we'll be talking about, you can play those on both the long and short side of the market. If you're bearish going forward, there are some very easy call credit spreads you can put on the indexes, which will go up in price and value as the market falls. All of that will be covered again later. So just wanted to give you a brief wrap, and hope everyone's having a great weekend. We will see you on the trading floor come Monday morning. Thanks. Bye now. God bless.